Welcome to the deep dive.
Glad to be here.
Today, we're taking a close look under the hood of BYD Company Limited. You sent us their first quarterly report for 2025,
That's right.
and our goal, really, is to pull out the most important insights, the stuff that really tells the story of how they're doing.
Exactly. This report, it gives us a detailed snapshot of their financial performance in the first 3 months of this year.
Okay.
We'll be focusing on their revenue, profits, and how their cash is flowing,
Right.
along with a look at their balance sheet, what they own and owe, and their income statement, which, details their earnings.
And shareholders, too.
Yep. Plus, we'll touch on who the major shareholders are and any significant happenings during this period.
So think of this as your guided tour through BYD's early 2025 financials. We're not going to get lost in endless spreadsheets, promise.
Definitely not.
We're here to spotlight the key changes and the things that, well, really matter. Okay, let's dive right into the big numbers, their main financial results for Q1.
Okay, so when we compare the first 3 months of 2025 to the same time last year, well, the growth in operating revenue is immediately apparent.
How much are we talking?
They brought in RMB 170.36 billion. That's a substantial 36.35% increase.
Wow, okay, so a big expansion in sales.
The very big expansion.
And the net profit attributable to shareholders, I saw that really jumps out.
It does. It more than doubled. Climbed by 100.38% to RMB 9.15 billion.
Double. That's a huge leap in how much profit they're making for their owners.
It is. And what's particularly interesting, I think, is that when you strip out any unusual or, one-off gains or losses.
The core profit.
Exactly. Their core business profit actually grew even more, by 117.80% to RMB 8.17 billion.
So that suggests the underlying strength of their operations is, well, very robust.
It does indeed. These profit figures, they paint a very positive picture.
But I sense a but coming.
Well, yeah. When we look at the net cash flow from their day-to-day operations, we actually see a decrease.
A decrease? How much?
Down by 16.9%, landing at RMB 8.58 billion.
Okay, that raises a really interesting question, doesn't it?
It does.
How can a company that's selling so much more and making so much more profit have less cash flowing in from its operations?
That's the puzzle we need to start unpacking, yeah.
Oh, could it be they're investing more heavily in things like raw materials to fuel that growth?
Possibly.
Yeah.
Or maybe shifts in when they're receiving payments from customers. Stuff like that.
We should definitely see if the balance sheet sheds some light on this.
Agreed.
But before we do, it's worth highlighting that their earnings per share, right? Both basic and diluted.
Absolutely. Those also almost doubled, increasing by 98.73% to RMB 3.12.
Which is a direct benefit for investors, obviously.
Directly. Okay,
Yeah.
So let's move to the balance sheet. Comparing where things stood at the end of March 2025 with the end of last year, 2024.
What stands out?
One notable change is a 45.1% decrease in something called receivables financing.
Receivables financing, remind me.
It's essentially when a company borrows money based on invoices it hasn't been paid for yet, like an advance on payments owed to them.
Got it. So that's down quite a lot. Why?
The report says this drop is due to an increase in endorsed or discounted notes.
Okay. What does that mean in simple terms?
Well, what's fascinating here is that this could suggest BYD is shifting towards using more promissory notes, like a formal IOU. Potentially indicates stronger relationships with their suppliers, or maybe a more strategic approach to managing their short-term obligations.
That makes sense. Maybe they're in a position to negotiate better payment terms or just optimizing how they handle their financing.
Could be.
What else on the balance sheet?
Another interesting detail is the 30.40% increase in prepayments.
Prepayments. So paying for things in advance.
Exactly. The report attributes this mainly to higher prepayments for materials.
Okay, connecting this back to their increased orders and revenue.
Right. This jump in prepayments likely means they're securing the raw materials they need in advance, locking them down.
Which could be a smart move, right? Maybe avoid supply chain issues or lock in prices.
Precisely. Shows a proactive approach to managing their supply chain, especially with that kind of growth.
And tying into that idea of increasing production, their inventories also saw a substantial climb, didn't they?
They did. Up 33.04%.
And the report links this directly to needing more stock for those growing customer orders.
Yep. It seems like they're just building up what they have on hand to meet demand. It fits the picture.
Makes sense. Inventory increase aligns perfectly with the positive sales trends we saw earlier.
Exactly. And finally, just looking at other key changes on the balance sheet, their development expenditures surged.
R&D spending, how much?
Up by 69.28%, a big jump.
And the report specifies this is mainly due to an increase in what's called capitalized development expenditures.
That's right. Essentially, instead of expensing these R&D costs immediately,
They're treating them as an investment.
correct, an investment that will benefit the company in the future. So it sits on the balance sheet as an asset initially.
Which strongly signals their ongoing commitment to innovation and tech advancement, crucial in their industry.
Absolutely critical. You have to keep investing.
Okay, so a lot of movement on the balance sheet seems to reflect this growth phase. Now let's turn our attention to the income statement. How did revenues and expenses stack up in Q1 2025 versus Q1 2024?
Well, with that significant revenue growth we talked about, it's not too surprising that their operating costs also increased.
By how much?
They rose by 37.45%.
Okay, roughly in line with revenue growth.
Pretty much, yeah.
Right.
The report attributes this to the expansion of their new energy vehicle business. So it seems like a reasonable, almost proportional increase given the revenue jump.
Right, and administrative expenses, the sort of day-to-day running costs.
Those also saw an uptick, 30.18%. Main factors mentioned were increased employee pay and higher material consumption.
Again, seems logical with a growing company producing more.
It does. But here's another really significant change. Their finance expenses.
Uh-oh, how bad?
Well, they shot up by a dramatic 883.88%.
Whoa, over 800%. What caused that? Debt? Interest?
Actually, no. The primary driver mentioned is an increase in exchange gains.
Gains. So it wasn't an expense increase in the usual sense.
Kind of confusing terminology sometimes, but yes, it means fluctuations in currency exchange rates had a very positive effect on their bottom line this quarter.
Oh, okay. That's a massive swing then, but in a good way this time.
A very good way. These kinds of gains can be unpredictable, of course, but they certainly provided a significant boost this time around.
Yeah, it's worth considering how sustainable those gains might be in the future, though. You can't bank on currency swings.
Exactly. It's a fair point.
On the positive side, again, their other income also saw a substantial increase, right? 83.61%.
It did. And the main contributor here seems to be an increase in government grants related to their regular business activities.
Interesting. So government support continues to be a significant factor in DYD's financial picture.
It looks like it, yes. Government support can often provide a crucial advantage in strategic industries like EVs.
Makes sense. What else on the income statement?
We also see a healthy 72.50% increase in gains from changes in fair value.
Fair value, like investments.
Yeah, they attribute it to increased gains on their wealth management activities. So it seems their investments are also performing well.
Good news all around there.
And one more positive note from the income statement. Their impairment losses on credit.
Money set aside for bad debts.
Exactly. That decreased significantly by 92.74%.
So fewer worries about customers not paying.
Seems so. The report says it's mainly due to a decrease in the provision needed for those bad debts. Suggests they're either getting better at managing credit risk or, their customers are just paying more reliably.
Okay. And then, unsurprisingly, I guess, with those soaring profits.
Income tax expense also increased substantially, yes, up by 84.66%.
Stands to reason. More profit, more tax.
Pretty much. So all these movements in the income statement, they tell a story of a company growing its sales significantly, yes, but also benefiting from things like favorable exchange rates and government support, while also apparently managing financial risks effectively.
Okay. Now, the report also briefly mentions extraordinary gains or losses. Anything unusual there?
No, it seems pretty straightforward. It says there weren't any significant items to report in that area, nor any recurring gains or losses that needed special highlighting.
Good. Let's pivot then and talk about who actually owns the company, the key shareholders.
Right. The report indicates the total number of ordinary shareholders is just over 203,700.
Okay.
The vast majority hold A shares, which are, traded on the mainland China market.
Yeah.
It also notes there were no preference shareholders with voting rights restored.
And the top 10? Any big names?
Well, the biggest holder is HKCC Nominees Limited, with about 40.38%.
Which is usually.
Often a nominee account for international investors holding shares through the Hong Kong Exchange.
Right. Who else?
We also see key individuals and institutions. Wang Chuanfu.
The chairman and CEO.
That's him. Along with LV Shengyang and Youngie Investment Holding Group Co., Ltd., among others in that top 10 list.
And interestingly, the report mentions connections between some shareholders.
It does, yeah. Specifically, the relationship between Mr. LV Zhangyang and the family of Mr. Wang Chuanfu.
I mentioned that.
Well, this kind of information can sometimes give you a sense of the interconnectedness of major stakeholders. Useful context for corporate governance, potential influences, that sort of thing.
Okay, got it. Finally, the report touches upon a couple of other noteworthy events during Q1.
Yes, it highlights BYD's ongoing efforts to, one, strengthen its technological capabilities.
Which lines up with that big R&D spend increase we saw.
Exactly. And two, accelerate its expansion into overseas markets.
Also aligns with the revenue growth, suggests they're putting resources behind these strategic goals.
Definitely seems that way.
Anything else?
And it also mentions the completion of a placement and issue of nearly 130 million new H shares. Those are the Hong Kong traded shares back in March.
Bringing in more capital.
Yep. Done within the existing shareholder authorization. And it would have brought in additional capital, presumably, to fuel those growth initiatives we just mentioned.
Okay, so a busy quarter beyond just the core operations. Let's try and wrap this up then. For you, the listener, let's recap the key takeaways from this deep dive into BYD's Q1 2025 report.
Well, I think first off, we've seen a very strong financial performance overall. Significant growth in both revenue and profit compared to last year. That's clear.
Yeah, the profit numbers are really striking.
They are. The balance sheet shows they seem to be strategically managing financing and building up resources like inventory and prepayments to meet that increasing demand.
And that finance expense line, worth remembering that the huge jump was actually due to positive exchange gains this time.
Right. A significant boost, though, as you said, something to monitor for consistency. And their continued heavy investment in R&D definitely underscores their focus on future innovation.
It's also worth remembering that point about cash flow, isn't it? While profits surged, their operating cash flow actually dipped.
Correct. Not necessarily a red flag on its own, could just be heavy reinvestment.
Right, like buying more materials or maybe waiting longer for payments as they grow. But it's definitely something to watch in future reports, just to understand the dynamics behind it.
Agreed. Overall, though, this first quarter paints a picture of a company operating from, well, a position of strength. Momentum seems strong.
Indeed. And this brings us to maybe a final thought for you to consider.
Okay.
Well, given the significant government support we saw mentioned and their stated ambition to rapidly expand globally, a key question emerges, doesn't it? How might the evolving landscape of international trade policies, maybe geopolitical tensions, and just the increasing competition in the global EV market, how might all that influence BYD's impressive growth trajectory in the coming years?
That's a really good question. This first quarter provides, a compelling snapshot of their current momentum, strong momentum.
But the broader global context, that will undoubtedly play a crucial role in shaping their future success, right?
Absolutely. The global expansion and keeping that tech edge. It'll be fascinating to watch how that plays out.